All right.
Okay, I think we're on. We're live, right? Ready to roll?
All right, let's
Okay.
go.
All right. So welcome October 2021. So another crypto update.
Yep, there's been a lot in the news lately, so we kind of wanted to
Good
focus this
stuff.
presentation around some of the different headlines we're seeing and dig in there, and then give sort of a top level overview of what we're seeing in the space currently.
Yeah, it would be a pretty quick overview. Paul's going to have a baby very soon, so we may actually get the phone call while we're in this call with you. So
I do apologize if I have to leave abruptly.
I think we'll be okay for the next few minutes, but one never knows. Okay, so let's check it out. So we'll go to our usual disclaimers.
All right. So this presentation is not investment advice. This is not an offer to buy or sell any securities. The information contained herein is believed to come from reliable sources, but we can make no guarantee to its accuracy. Please review our disclaimers, terms of service, and use at investwithwillow.com/disclaimer.
Okay, so here we rock and roll. So that's us. And I'm sure more and more of you are starting to see the headlines cross, which gets us excited because we know we're early to the game or early to the scene. And I don't know, Paul, what would we say? We're still in the incubation stage.
It's still very early, but we're seeing, especially like these two news headlines right here, this whole idea around stable coins and digitizing dollars is only gaining more and more adoption. I mean, we have like this one right down here says US FDIC is starting to now study these things and take it much more seriously than they had in the past. And the Fed paper recently came out.
Yeah, this is amazing.
Citing cryptocurrencies as a direct threat and challenge to the US dollar. This is huge.
This is huge. This is huge. And we find it really curious that that's coming from a Fed study. And we're starting to see large, Brazil going into and creating Bitcoin as a legal currency is a big deal. It's not done deal yet, but we think it's a high probability. A high probability actually that probably all of South America will end up. This is just our speculation, our belief that that'll end up going in that direction.
More and more countries are starting to put these kind of proposals to their legislators. And it just seems like this is one of those snowballs that is rolling and growing and growing and growing. So.
So that's when we saw this Fed paper, both Paul and I were a little shocked, but pretty excited to see the news. So the second thing is discussion around whether stable coins should be determining whether stable coins should have FDIC insurance. Okay, so this isn't, we can't call it an asset because it's not considered an asset yet. It's not considered a security. It's kind of has its own whatever at this point. I don't think there's really a term for it. But the fact that the FDIC, they're having discussions about insurance for stable coins is a big deal. And Paul, do you want to talk a little bit about stable coins just really quick here so everyone can remember this?
Yep. So the idea of a stable coin is that you have a token or something that is that lives on a specific blockchain. And it could be one of numerous different types of blockchain, but that token is backed by something in the real world. There's a real world asset that is custodied or held somewhere that backs the value of this stable coin. That could be dollars, that could be commodities that back these things. There's some gold backed ones. Was it Colombia tried to do an oil backed one that was banned in the US for some pretty serious reasons. But different things like commodities or different country dollars like euros or whatever could back these things, and they're custodied and held at a bank, and there's a direct one-to-one accounting. There's also the idea around using other digital assets to back some of these, and it gets more into the esoteric realm of like algorithmically backed stable coins, but we don't need to touch on that yet. Either way, this is like a way to make this whole space much more usable, because instead of trying to transact on these networks with an asset like Bitcoin or Ethereum that has very high volatility, where its actual dollar value is constantly fluctuating, this gives you that stable value, but it allows you to then use these networks and transact in a way that is arguably much quicker and more transparent than many of our current infrastructure and systems.
Let's move on. More headlines, all good stuff.
Institutional adoption Yeah.
This is huge, you know, US Bank.
Fifth largest, is the fifth largest bank? Yeah.
Fifth largest custody bank
Mhm.
is now going to be custodying cryptocurrencies. JP Morgan, this is interesting. So their institutional investors, they noted, are favoring Bitcoin over gold. Now, if any of you saw the news headline this morning, JP Morgan from Diamond, the CEO for JP Morgan, said that, what do you say, Bitcoin, he thinks is
It's a
worthless?
worthless asset or something like that, yeah.
It cracks me up, but the company itself is moving. Now, understand, the company itself is moving into cryptocurrencies. It's literally providing custody now. It's literally going to be doing what for is it Coinbase?
It's building infrastructure and inroads to allow
mean-
for people to start transacting and moving their dollars basically into this whole digital world. So they're really embracing the technology and moving in this direction in a pretty significant way. Yet the CEO is saying
It's worthless.
So
This
makes us go.
Yeah, makes us go. So these are things, that's why we always we're paying attention to these headlines because they grabbed us. But when we see headlines such as that, we dig in deeper to see what's actually going on there.
Right. And it's beyond, a lot of this is beyond just Bitcoin. So this Bank of America study that came out was saying that they're noticing all sorts of demand, and the firm is really exploring how to tap into, different protocols that are on things like Ethereum, and just more and more development in the space.
Yeah, and I just want to talk really quickly about DeFi, so decentralized financing. So understand, DeFi, really has been a concept that's been around for forever, so that you see many family offices, big money, they literally finance for themselves, okay? They have alternative ways to finance other than banks, right? DeFi is another alternative way to finance other than banks. So smart money's been alternatively financing themselves for many decades. So what DeFi actually does is opens it up. Paul, do you have anything to say about this? Anything to add?
Yeah.
It opens it up to the whole as opposed to the few, in a different way, of course.
Right.
Yeah, the concept
is extremely similar.
Yep.
And that instead of this sort of field being accessible to only a few, it really opens it up to a much wider population to interact with these newer protocols that are different than legacy things, but it still allows more people access to this space. Another interesting development, we don't have a headline here, but Visa has just deployed one of its first smart contracts on the Ethereum test network, or one of the dev nets that help test out different things. And they have this whole plan of creating basically the back-end infrastructure to facilitate global processing of central bank-backed digital currencies. So it'll be really interesting to see what they do there. But the fact that these companies are expending resources on this type of thing is another signal to us that this is the direction it looks like. Right.
Yeah. All right, let's go on. We got more headlines. Oh yeah, family offices. So unfortunately, I could not retrieve the article I read one morning at breakfast. There was an article with beautiful graphs that were showing to me, and we have them here, that family offices had a very large share, and besides, the other, in comparison to investment advisors, in comparison to institutions and retail, which is the small investor, that family offices, which is traditionally, by the way, the smart money and the 0.1% that controls a lot of the wealth around the globe, they had a larger percentage in cryptocurrency. And that is the case here in the United States, this chart shows.
Yeah, Fidelity Digital Assets did a study, and we're going to provide links in our summary email, and we'll have links to most of these articles and some different studies, and hopefully you guys appreciate that. But what's really amazing here is that high net worth individuals in Europe, currently over 84% of them have exposure to this asset class. So, and it's just been growing in the US, and then you look at in Asia in general, and it's around 86%.
Yeah.
Right now, US is lagging in that space, but what we've seen is that it's increasing at a pretty significant
rate. Very, 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 we're getting more interest from advisors and as a whole. And, George Soros, again, a big family office, is seeing that his company is seeing Bitcoin as a better hedge for inflation. So, okay. So some of the big money is going behind this more and more and more, which we knew behind the scenes, but okay. Anything else? No, that's not. Okay. Okay, this
This is a
is great.
snippet from a recent study that Fidelity Digital Assets did, and there's just some really interesting points here that we thought were definitely worth
Mhm.
pointing out. So
Yeah, let's
I don't
point
wanna-
some of them out. Go
Mhm.
ahead. Let's give them, you know, you can see this slide, but maybe Paul, you can point out
Mhm.
some of the salient points here. Some big ones.
let's see.
Let's pick it
So
up.
right, 70% of all investors have a neutral to positive perception of digital assets. I mean, this is huge. This whole idea of around mimetics, or the idea that we sort of copy each other, right? When something is perceived by as acceptable by a large group of people, typically that spreads.
And then
And
it
that's
becomes
what
acceptable.
makes something acceptable, right? That's
Exactly.
why gold has value, right? The shiny
Yeah.
rock has value, right?
Yeah, exactly.
Because we agree. So
Mhm.
the fact that there's a skew towards the positive to that is generally a really good positive sign.
Mhm.
Um,
So, you know, I don't think we put it here, Paul, but what we are seeing, there's places you can go that can actually show you the amount of transactions. Do we have anything about an update on the transactions now that are taking place? Thought we might have a
there
chart.
might be some slides.
Okay, yeah, okay. So, you know, we are seeing a wider and wider adoption, wider and wider use of the digital assets, and you're seeing more transactions taking place on these platforms.
Right. There's been a big push recently for institutions to try and add these things to their balance sheets, which
Yes.
currently many of them. Well, you can explain.
Yeah. Right now, you're not allowed to put the digital assets on a balance sheet because it's not considered an asset.
Without approval from your board and a whole slew of compliance from the companies, because there are some companies like Coinbase, for example, does actually have digital assets on their balance sheet, but very few. MicroStrategy is another one, but very few other companies.
And those are companies that are doing digital assets. I mean, that's what they're doing. But when you look at the wider scale of corporations across the globe, they are not putting this as an asset on their balance sheet yet until it is defined truly as an asset.
But they want to.
But they want to, and they're pushing for it. So again, you know, it lends to the credibility of the space. Let's keep going on down. Oh yeah.
Yeah. So here's just a quick chart of the total cryptocurrency market cap. You know, this isn't the greatest number to measure use, but it shows, I mean, we are at over the $2 trillion mark for the entirety of the digital asset space. And it's, you know, this is nearing its previous all-time high back in May.
Of course, we want to see it break. Paul and I are very much technicians in a lot of our work, and it's very important that we see it break above these. All right, let me get this. All right, where am I?
That May 2021-ish level of maybe 2.5 trillion or so around there.
We want to see it break above that, obviously, for it to become even more bullish.
Right. But it shows that, you know, there is momentum here, and overall the trend is generally intact up and to the right.
All right, let's roll on, baby.
Yeah. So here is an interesting chart, and I'll explain this, and I'll provide a link if you want to dig into this and really see what all the different colors represent. But this is the total value locked on all of these different chains. So this is money that people have taken out of dollars and put into different protocols that lock it into DeFi or just different smart contracts, and basically a way to take dollars and then lock them onto different blockchains. And the purple at the bottom is actually Ethereum network, and the others are all the different competitors on top of that. But you can see that this is actually recently did hit an all-time high of value locked on these chains. So that's another huge indicator for adoption.
And keep in mind, if there's any bankers on the call, this leads to disintermediation of the banks, obviously. So let's just explain, if somebody's locking some of their money into DeFi, that means that money is being lent out in a different way than at the banks. Okay, so, you know, again, you have your money in a bank, the bank is lending it out with mortgages and so on, and commercial credit, you know, for businesses and so on. DeFi, decentralized, taking it away from the banks, disintermediation. Okay, like this is why the banks are trying to get into this in a larger way now, because they recognize that disintermediation, meaning money coming out of the banks, will transpire if they don't begin to participate in this DeFi space. Would you say that's fair, Paul?
Absolutely.
Yeah.
As the chart shows right there in the numbers, it's
heading in the direction.
Wanted to touch briefly on regulation because there's been a lot of rumors floating around, and right here, White House is trying to push an executive order maybe to force regulators to do something because it seems like, I don't know if feet are being dragged or it's just a very confusing space. And you know, you have these really legacy players in trying to use old rules on new technology, running into issues, trying to figure it out. Overall, though, our assessment so far has been that generally, while regulation can seem, you know, frightening or scary in this space, ultimately it's a really good thing. As long as it's thoughtfully done.
Exactly. It has to be thoughtfully done, and it lends credibility to it becoming an asset class. You know, at some point it will have a definition as being an asset class or some security of some sort. And in that thoughtful regulation, and again, we're going to say thoughtful regulation. Thoughtful regulation is really important. Paul aptly pointed out at a previous call that we had that when the internet first started, it was illegal to encrypt mail. Okay, illegal to encrypt email, which now we know we have to do to secure personal information. So that's the kind of stuff we think maybe there might be some silly things that are added in because of a misunderstanding. It's a black box for many, and he knows a lot more than me. I've been studying the space too, but it has a lot of moving parts to it, and there's a lot to learn here. So the people making the regulations have to come up to speed on a lot of what this is all about.
Right. And I think what more and more regulators are going to find as they dig into this space is it really is self-regulating in many ways, due to the transparent nature of how public blockchains work. I mean, you get complete line of sight into exactly how money moves from one person to the next or one contract to the next, who it acts with. And then from that, and how these smart contracts are completely open source and open, you can actually see where the risk is, you know, where's your counterparty risk and how is that managed? And it's just, I do firmly believe that once regulators really dive into this and start understanding these things, they'll go, oh, wow, this is a much more transparent system actually than a lot of the current. I just thought of something that might be helpful for the future, Paul. We might want to actually go in live and show some of that data so people can see live how it ticks on, because here we're talking about it, but you can actually view it. This is all open. These are open, transparent systems that anybody can log into and look at and examine for themselves and then say, okay, I feel comfortable with this or I don't. I mean, there is a level of technical understanding that's probably required to understand the coding piece of it, but still, you can't really do that in today's world or in our systems currently.
You can't if you're at the bank, but even there. So, okay. So anyway, we don't see this as a negative. We see it as a positive as long as it's smart. Okay, let's see. I think they should call Willow and ask some advice. Okay, so questions, please. Let's open it up.
All right. So
do we have some? Okay. We have some trickling in.
All right. So we had one question that came in via email that was, what are our thoughts on Solana? And Solana is I guess, Ethereum competitor, a smart contract blockchain platform. And so thoughts on it, right? It's very cheap to use. It's much easier to use and do transactions on it than it is currently to use like the Ethereum network. I think the average transaction price is in the pennies or something compared to something right now on Ethereum where it's in the tens to 50 to potentially hundreds of dollars to do some of these transactions while they figure out that scaling. The one major drawback I would say to something like Solana compared to something like Ethereum is how decentralized and distributed it actually is. It was a few weeks ago, I believe, that something went wrong with a key technology piece of Solana, its sequencer or something. There was an error, it went offline, the entire network was shut down for 18 plus hours. And that's not really going to fly if you, have a massive amount of money that you have on one of these networks and you're looking for security. The more distributed one of these networks is, the more built-in resiliency it has. If one node goes offline or something, it's not so much a big deal. With something like Solana, if one node has many, many fewer nodes than something like Ethereum. If one of those things goes offline, it can be extremely detrimental to that network. The other thought I have there is this idea of monolithic blockchains versus modular blockchains, where in monolithic blockchain, you're trying to do everything on that layer one. So you're trying to do the security, the data availability, the execution of everything, all on this one piece of technology. And what that means is that the hardware required to process all of that just grows with time. As that ledger gets bigger, you need more and more computing power, more and more resources to provide the same level of security, as opposed to more modular blockchains where that might have special pieces that are specialized to do something just like security or data availability. So while there's a lot of venture capital that has been put into something like Solana, and it's really taken off over the past several months, it is really cheap to use. At this stage, I would be hesitant to say it's a real replacement to some of the more distributed blockchains out there, and that it does present risks, maybe a higher level of risk than, again, more distributed blockchains too, based on the
more mature, the more mature blockchains.
Yeah.
Like Alice, what other questions do we have?
So we had a question about what was our green energy source. So I think this references some presentations we had done in the past that was talking about what percent of basically the mining power comes from renewable sources. And I believe it was the IAI. There were different, and I think it was, I'd have to pull them directly. They're referenced in the previous presentation that we've done, but they were some pretty large organizations. One of them, I believe, was one of the top 4 accounting firms. That was,
McKinsey,
I think, was one of the providers of that data. Also, a global multinational bank was also the provider of that data, and then a couple of governments also contributed. So they weren't, just random sources online. It was actual organizations. At the time, and I'm sure this has changed since then, but it was something like 78% of proof of works, the energy required to sustain the proof of work network, something like 78% of it came from renewable sources.
Yeah, and if you look right now, the areas that are winning these, where the miners are going, is Texas, which is a good sunny state that's moving into renewables very quickly, right? But also New York. Yeah, New York, which
hydroelectric.
Yeah,
a lot of these mines set up next to dams and places that, and they take their off-peak energy and convert it into security for these networks, basically.
So I'm going to ask a question, Paul. Like as Ethereum moves in next year when they have their upgrade, how is that going to affect mining?
Sure. So Ethereum, the second largest blockchain behind Bitcoin, is changing its consensus mechanism from proof of work, which requires a lot of electricity and a lot of hardware the miners to and what that all does is provide security for that network. Ethereum is changing its consensus algorithm to something called proof of stake, where you no longer need miners essentially to provide that type of security. The idea in proof of stake is that you're taking Ether, the native token on Ethereum, and staking it on a validator, and using that as a way to say that, okay, all the transactions that come through are verified and correct. If you tinker with those or try to change it, right, to game the system or find some kind of benefit, the rest of the network's going to recognize that and then do what's called slashing, or really there's an economic disincentive. So you get slashed and you would lose a part of your stake. So that in and of itself creates the economic incentive to stay truthful.
Yeah.
What that transition also means is a 99.9% reduction in the energy required for that consensus mechanism, because you no longer need these specialized hardware systems that require a lot of energy to crunch and do all the math and the proof of work system. Instead, you just need, some of these things can run on an old laptop or even a Raspberry Pi, which is a little tiny piece of hardware.
Will other digital assets move into the same direction, where there eventually may not be the need for as much electricity.
Yeah.
Yeah.
Yeah, we'll see.
Yeah, we'll see.
Most likely, I mean, I think the economic incentives are there to encourage these kinds of transitions, especially with the ESG pushes that we're seeing and more countries saying, you know, trying to address it. Because to secure the Bitcoin network or in all of proof of work in general does require a lot of electricity. There's a lot of energy that is used to do that. So to have a massive reduction in that would be a net benefit really to us all.
Okay, what other questions do we have?
So those are the main ones I'm
Has
seeing
anybody
that
else
came in.
anybody raising hands here? Gabby, do we have anybody raising their hand for a question?
All right. Well,
All right.
we will follow up with an email. We're going to provide a whole bunch of links, especially to all those articles that we referenced. We'll throw in that study
Yeah.
from Fidelity.
I have
Question and Q&A.
Okay, here we go. We have another question.
Okay.
Hold on.
The question is, how are capital gains tax figured on the buying and selling of crypto? Like, is it similar to currency, right?
Okay, so
Yep. So it's very similar to property, right? So it either, if it's sold within a year, it's treated as a short-term realized gain,
Flows to normal income.
right? It flows to normal income, and you pay tax on it that way. If it is long-term and you know, over a year, and something's held for over a year and then sold, it's
Capital gains,
treated with long-term capital
20%.
gains tax, right?
20%.
Yeah, depending
At this time.
right?
Yeah. So.
Yeah. So it's similar to property in that sense too, where if you know, buy something and sell it, you're liable to pay tax on the gain,
Exactly.
unless this is in a tax advantaged account, like an IRA or something. Then
Which you can do.
which is possible.
When we first started dabbling in this, there was no option to do that in our 401ks and our IRAs and so on. And now, of course, it's open. So what else? What other questions? Do we have any? I think not. Okay, so it looks like we nailed it. And for those of you who want to meet with us, we'll be meeting on Thursday about traditional markets. Hopefully Paul will be with me, but if he's not, I'll be doing it by myself. So, okay, everyone.
All right. So
Thank
look for that
you.
email. And as always, if you have any
Yeah.
other questions or, you know, want to get into something in a little more depth, feel free to reach
Yeah,
out,
give us a
give us a
ring.
call.
Okay.
All right.
Bye.
Take care.